Welcome to ARGUNAS Learn. So, when you start investing, you pretty much immediately come to this huge fork in the road. The big question is, should you manage your own money or should you hire a professional to do it for you? And let me tell you, this isn't just some minor detail. It's a really big decision, one that's going to shape your financial future in a major way. I mean, think about it. Your answer here, it's going to have a direct impact on your returns, right? But also on how much of your personal time you're going to have to sink into this, and honestly, your peace of mind. So how do you make the right call for you? It's so important to get this right from the very beginning.
Okay, so here's how we're going to tackle this. First, we'll look at the core decision itself. Then we'll explore the two main paths, doing it yourself versus going pro. After that, I'll give you a simple framework to help you choose. We'll even check out how this applies in real life and wrap up with a quick look from the NISM exam perspective. Sound good? Let's dive in.
You know, the world of investing is just flooded with options, right? You've got stocks, bonds, real estate, so many choices. But here's the thing. Before you even get to picking what to invest in, there's a much bigger, more fundamental question you need to answer. How are you going to invest? Are you going to be the one in the driver's seat, making all the calls, or are you going to hand the keys over to a professional? So that brings us to the two big paths we've been talking about. Do it yourself, or what we call DIY, versus getting professional help. Let's really break down what each of these approaches means, because trust me, your role in each one is completely different.
All right, let's talk about the DIY approach first. When you go DIY, you are literally the captain of your own ship. You're the fund manager, the analyst, the administrator, you're doing it all. We're talking everything from digging into company reports and deciding what to buy and sell to handling all the nitty-gritty paperwork. Yeah, successful DIY investing really boils down to three things: solid research, clean execution, and unwavering discipline. Think of it like a three-legged stool. If one leg is weak, the whole thing comes crashing down. And you know which leg is usually the wobbliest? Discipline. It's having that emotional control to stick to your plan, even when the market is going completely haywire. So let's just put these side by side for a second. With DIY, the big plus is you have total control. But the flip side is you're doing all the heavy lifting. It needs your time, your energy, your expertise. Now, with professional help, you're basically outsourcing all of that. You're paying for expertise and for someone else to manage the process. And one of the most popular ways people do this? Yep, through mutual funds. Okay, and this next point is so important, I really want you to get this. A lot of people mistakenly think of mutual funds as a separate asset class, like they're in the same bucket as stocks or real estate. They are not. A mutual fund isn't the destination, it's the vehicle. It's a method for investing in those other asset classes. When you buy a mutual fund, what you're really doing is hiring a professional, an asset management company, or AMC, to do the driving for you. So the big question remains, which path is right for you? Look, this is a super personal decision. There's no single right answer. But I can give you a really simple but powerful framework to help you figure it out. It just boils down to asking yourself three very honest questions. First step, can you actually do it? And be real with yourself. Do you have the knowledge, the skills, and honestly, the time? Second, do you even want to do it? Is this something you're passionate about, or does the thought of spending your weekends analyzing charts make you want to run for the hills? And number three, can you afford to outsource? Now, this last one, it's trickier than it sounds, so let's dig into what cost really means here. You see, most people assume that DIY investing is free. I mean, you're not paying a fee to a manager, so it's free, right? Wrong. There are some serious hidden costs that most people don't think about, and they can really take a bite out of your returns. Let's walk through a quick example, and you'll see exactly what I mean.
Okay, let's imagine you've got 10 lakh rupees ready to invest.
Now, if you go with a professional, a typical fee, what you'd see as the expense ratio on a mutual fund, might be around 2% per year.
So, on that 10 lakh portfolio, what does that come out to? Well, that's a direct cost of 20,000 rupees for the year.
And that might sound like a lot, but hold on. The real question you have to ask yourself is this: is your time worth more or less than 20,000 rupees a year? Think about all the hours you'd have to put in to do a good job managing that money yourself. For most busy people, that time is worth way, way more. That's what we call opportunity cost.
So, you see, the real cost of doing it yourself isn't zero. It's the value of your time plus the cost of your mistakes. And let's be honest, those mistakes can be huge. We're all human. When markets get volatile, it's so easy to let fear or greed take over, to sell at the bottom or buy at the top. And just a couple of those emotional gut reaction decisions can be absolutely devastating to your long-term returns. It can literally undo years of hard work. At the end of the day, there's no magic formula here. There is no one-size-fits-all answer. For some people, the folks who have the time, skill, and temperament, DIY can be a fantastic path. But for most of us, with busy lives and other priorities, getting professional help is probably the more practical, and frankly, often the smarter choice. The best approach is always the one that fits your life.
Okay, so let's make this even more real. Since it's all about finding the right fit for your specific situation, let's look at a couple of quick profiles and see how this choice might play out for different kinds of people.
On one hand, you have a busy, salaried professional. Think of a doctor or an engineer or an IT manager. Their time is incredibly valuable, and their core expertise is somewhere else, right? For them, trying to become a part-time fund manager on top of their demanding job, it just doesn't make sense. Outsourcing is the clear winner. But then, on the other hand, you might have a full-time market participant. They've got the time, they've put in the work to build the skill. For that person, DIY could be the perfect fit.
And that's really the key takeaway here. This has to be a decision based on suitability, not on ego. It's so easy to think, oh, I'm smart, I can do this myself. But you have to be brutally honest with yourself. Don't let your pride make a decision that your portfolio will later regret.
Now, for all of you studying for the NISM exam, pay close attention. This exact logic of suitability and understanding the trade-offs is precisely what they test you on. The exam isn't going to ask you, is DIY better than professional help? No way. It's going to test if you understand the underlying concepts, the pros and cons, and the logic behind the decision. And they love to set traps based on common misunderstandings. So here are the things you absolutely must remember. 1. Mutual funds are a method of investing, not an asset class. 2. Don't forget the hidden costs of DIY, like the opportunity cost of your time. 3. Never compare professional fees to zero. Compare them to the full hidden cost. And 4. Never underestimate the financial damage that your own behavioral biases can cause. Nail these points, and you'll be in great shape.
All right, let's do a super quick recap of everything we've covered here on Argunus Learn. First, every investment has to be managed, either by you or a professional. Second, DIY is a serious commitment. It demands your time, skill, and a ton of discipline. Third, remember that mutual funds are simply a way to outsource that management job. Fourth, you have to look at all the costs, direct fees, and the hidden costs of time and mistakes. And finally, the most important point of all, this is about suitability. Choose the path that genuinely fits your life.
And that's a wrap for this concept on Argunus Learn. Now that we've established the how, our next video will dive into the what. We're going to take a much closer look at what mutual funds actually are. So if you got value out of this explainer, please do me a favor and hit that like button, subscribe to the channel, and ring the bell so you don't miss what's coming next. This video is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, AMFI, or SEBI. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.